Alrighty, we are live here in our studio here. So waiting for some folks to join. So welcome everyone to our October commentary. Um, and folks are joining in right now. I am joined by my colleague David. So today we've got some good information for you guys. Austin is actually taking a breather. Austin is in Portugal right now, according to his Facebook page. He looks like he's having a great time, David. Have you seen his Facebook page yet?
Yeah, I have. He's been doing a lot of hiking and trying out some new foods. So it looks like he's having a good time. This month we're going to take over here. Like Neil said, we have some good information, not just on markets, but we're also going to take a little look at taxes here today. Everybody's favorite topic.
Yeah, and to share some personal news for me, I'm going on a trip to Vietnam. So going to be my first. We are doing a long trip, halfway around the world because we are expecting in April. So we're going to get a little bit of the travel out of us before we hunker down. So that's the news on my front. David, any news on your front?
No, nothing as exciting as you guys.
Okay. All right. Good. Good. I'm glad. So no surprises. Is what you're
No
saying.
surprises. Yeah.
Okay. Okay. Good. All right. Cool. So David, why don't we talk a little bit about then what's been going on lately in the economy? I know half of our presentation is more about taxes, but tell us a little bit about what's going on.
Yeah, so for any of you who have been joining, over the past year, you know that, one of the main topics of our presentations have been around taxes and inflation and interest rates, and really what's going on with the Federal Reserve and our projections on when they would finally start to cut rates. Well, it finally happened. On September 18th, they cut rates by 0.5%, which is actually a little bit more than what was previously expected. We only expected them to cut them by about 0.25% until we got a little bit of weaker labor and economic data about a week or so before that Fed meeting. So they're taking a pretty aggressive stance, doing 0.5%. And really, these rate cuts are expected to continue over the next 3 years, potentially longer, of course, as we know they're a little unpredictable. But they have a very thin line to cross here. They have to make sure that they are cutting rates to avoid a recession, but also not cutting them too quickly where inflation becomes an issue again. And what we've seen is this is really translated over to a number of different markets, right? Now, where do we see the Federal Reserve have rates go? And we have a little complicated chart here, so I'll break it down. We have the Federal Reserve, it's called a dot plot. Again, for those of you who have joined past commentaries, you've probably seen this before. Now, to explain this chart, in the light blue, we have what the Federal Reserve was projecting rates to where rates would go at their June meeting. And then in the darker blue, we have where they have more recently projected rates to go. And what we essentially really see is in 2024 and 2025, their September forecasts have really shifted quite a bit further downwards than what we saw back in the June meeting. In other words, they have become a little bit more pessimistic about the economy and understanding the need to really drop rates at a faster rate during this year, 2024, and next year, 2025, which is going to be a good sign for the economy that the Federal Reserve sees this as becoming a problem and they're going to address it head on before it becomes an issue. And that means that smaller and maybe medium-sized stocks will improve, the bond market will improve. Also, for any of you, I know a lot of people I've talked to have said this, they've been pausing, relocating homes simply because rates have been really high, right? And the question has been, well, when is a good time to eventually relocate? I'm retired, I want to move somewhere warmer, wherever it might be. So, if you can jump over to the next slide here, one of the things that we'll see is mortgage rates are continuing to dive, right? They, very early this year peaked at about 8%, and they are right now down at just about 6%. And with this more aggressive stance from this Federal Reserve, we should see rates come into the fives and maybe, if we're lucky, into the 4%. Yeah, you just
Sorry.
got the slides. And maybe even into the 4% at that point. So we are expecting mortgages to go down, but something to be aware of if you are planning to buy a home or your kids are planning to buy a home is on the next slide here, we want to look at what that means, right? If mortgage rates go down, we want to remember that housing prices are going to be going up. So looking at this, you can see that in July this year, we just hit a record high, and that is really going to be continuing higher, especially with those rate cuts that we just experienced here last month. So timing of home purchases, if you are relocating, you want to kind of balance the two, and some guidance would really be look to get a place before home prices climb higher, and then look to refinance when loans drop. So a little bit more information.
What do we think about the Florida market, David? Do we think prices are climbing higher, or are we thinking people are ditching their homes?
Yeah, not with all the hurricanes and the increases that we're seeing to insurance. So we do want to say records highs is a national average. Now, obviously, that's going to be area specific. There are some areas like Phoenix and Austin, Texas, where they also saw leaps and bounds of growth, and that market is actually slowing down a bit. Prices are kind of correcting, but the majority of the country are heading higher.
Okay, that was more so a joke, but I was looking at Zillow and Redfin this morning. Our friends were sending us, the news clips of Florida, St. Petersburg, and areas that we have been following, and looks like people are already starting to mark down their sales there. You're seeing flooded, sold as is. So it'll be interesting to see if Florida stays as red hot as it's been over the last couple of years.
Mm-hmm. Yep.
So this is kind of a chart we put together to show you the history of the prime rate. So the prime rate is a fairly interesting rate to follow because it shows a lot of more so short-term borrowing costs in terms of interest rates, right? So maybe home equity loans, those types of things are based upon the prime rate, and so are mortgages for the most part, right? So as we start to see the prime rate here, the big thing about this is that we kind of got up to some of the highs that we saw in the early 2000s, right? But it looks like the Federal Reserve is pivoting from this higher for longer stance, and we're starting to kind of make that drop to the other side. And as you can kind of see here, it's very unlikely that we're going to go back to those levels that we saw in the 80s and so forth, which are that spike in the middle. We're kind of coming back down to that long-term average, and that long-term average has been somewhere in the 5%, right? Is that what you see too, David?
Yep, exactly what I see. And back to the 5%, and when they have spiked rates this sharply, you notice most of the time they've come down pretty quickly thereafter.
Right. Yep. So that's kind of what we're seeing here. We're seeing a reversion back to the mean. We will most likely be headed that way as long as what? As long as inflation continues to fall. So this is the one that's got to stay on top of. If that number starts to rise, that could change the Federal Reserve's path forward. Now, what are some things that could change the Federal Reserve's path forward? Well, there is the strike going on at the ports. Mm-hmm. And that is concerning because what is essentially happening there could affect inflation. Essentially, you're having employees strike for higher wages, which essentially translates to higher prices if they essentially get what they want. And that's something that could impact inflation over the next 6 to 12 months if there is a significant increase to those wages. So I hate to be rooting for someone not to get a raise, but at the same time, I don't want to see a significant spike to something that's already been coming down, really more so in that 2% range, which has been where that Federal Reserve has wanted that figure to come down to start reducing the rates, which is what we're seeing right now. But if we were to see that start to increase back up, I think that will change their path forward completely. You'll see those rate expectations actually begin to at least rise or not fall, and therefore we have this kind of stickier inflation happen. So a lot to be seen here, but things are trending in a good way. And I think what we'll be watching in the next couple of months to come is what the Federal Reserve does. And these are some important dates on the Federal Reserve Committee for 24 and 25. These will be the next time frames where they're assessing their own interest rates. Anything else to add on that front, David?
No, I think really just all eyes are on November, right? What do they do? Do they pause and skip a month with cutting, or do they proceed to cut? Because right now they're projected to cut rates another 0.5% this year. That could be 0.25% at each of the two meetings. That could be 0.5%. And not just what they do, but what their language is about what they're seeing and what they're planning to do moving forward is going to be the secondary item. So we might, on top of the election, see markets move in a bigger way depending on the outcome of these meetings. And I wouldn't doubt that there wouldn't be a market swing on the second day of each of these meetings on November 7th and December 18th, depending on what they ultimately decide and what they say afterwards when Powell speaks.
All right. Let's end our talks on rates and the Fed. Let's go to something a little bit more pressing, which is going to deal with the election. And David, if I'm not mistaken here, you got some good information to show us about each of the candidates' tax proposals, how that's going to affect our bottom line and our pockets. So I'm interested to hear what you got to say.
All right. Well, let's get into the tax proposals. Now, there are a lot of interesting things that have been, thrown in the ring. And one thing I want to mention before we kind of cover any of these is this is their proposals so far, right? Remember, this would have to pass through Congress, and there's going to be probably many iterations to whatever is proposed. Some of the interesting things that may differ from one another is a lower corporate tax rate under Trump. He was looking to eliminate federal taxes on Social Security. So that's a very interesting one. A lot of states out there don't tax Social Security, but there's always been federal taxes on it. They're looking at actually not taxing that. So that would be a little bit more money in everybody's pocket in retirement, should that go through. Eliminate taxes on tips and overtime. Now, the reason overtime is emphasized here is as we move to Harris's plan next, Kamala also wants to eliminate taxes on tips, just there wasn't any language for overtime pay in her proposal. He wants to make the Tax Cuts and Jobs Act of 2017 permanent. To elaborate on that a little bit, that means that these lower tax percentages would be here to stay and would be permanent. As of right now, these tax rates are going to expire at the end of next year and go back to the old percentages from 2017. So you're looking at roughly about 3% more in federal tax if this does not get extended or made permanent. Another big one that is really the reason that the Tax Cuts and Jobs Act of 2017 was so bad for a lot of people is in the top right here, we have the SALT tax, right? It was a limit on how much you could claim on your property tax and your state and local tax payments, right? You were capped at $10,000. this is the reason a lot of folks saw that their taxes increased under that plan where they thought, right, their tax percentages were lower. They thought they should be paying less in tax. So something being proposed is the unlimited deduction for that.
And that would include property tax too, right? Because it was a $10,000 cap on property and state tax, which if you had, let's call it $8,000 of property taxes, and then you had $12,000 of state income tax, you had $20,000 of deduction there that you couldn't take, right? Because you were, I mean, well, you could only deduct 10,000. Now that's going to be unlimited in terms of that proposal, right?
Yep, that would be a lot of savings for a majority of people, especially anybody who lives in a state where there is higher property tax or higher state tax, right? Anybody in Washington, D.C. especially will feel that.
However, they did make the standard deduction super high, right? So it probably wouldn't affect, in my opinion, just analyzing this, folks that are joint filing, because folks that are joint filing have double the standard deduction than single folks, right? And if we look at the standard deductions, they're almost close to what, 13,000 for single, 27,000 for joint, right? But where I think this SALT deduction hurt people was that this $10,000 cap, guys, was for single and joint. That was super unfair to the single folks that had the same cap as someone that would have a joint. So from a joint standpoint, I don't think it makes a big difference, but for a single person, I think it's a big difference, and therefore the single filers would most likely start to itemize again, whereas those joint filers probably still take the standard deduction.
Yeah, very good point, and that's definitely true. Last couple things just to wrap up the Trump proposal here is looking to tax private university endowment funds. There's only millions of funds that have had preferential treatment here, looking to start beginning to tax those. And then finally, a little bit of a reach here is looking to impose a 20% increase in tariffs on imports. Maybe this could actually be what covers some of those port workers' increased wages. And even looking at 60% on China. The reason for that, as many of you probably know from the 2018 tariff war with China, a lot of that came to the fact that there's a big discrepancy in what we're importing from China versus China importing from us. So there's a little bit of an unbalance there. And then one just very interesting thought here is possibly to replace income taxes entirely with tariffs. I think that would be a very big reach, and that would probably upset a lot of other countries. It'd be interesting to see kind of if that was to take off at all. But I think that could just be something thrown in to make the campaign maybe look a little bit better. But replace all income taxes from all citizens with just tariffs is essentially what that is saying.
Right. Okay.
So let's go ahead and move on to the Harris proposals. And really, there's kind of a few things here that we're going to want to elaborate on, and Neil, I'll ask you to actually maybe kind of help out and explain the capital gains and net investment income tax slides here.
Sure.
Now, in the case with Harris, she's looking to raise corporate taxes, right? We want these corporations paying their fair share, and that would be increasing them from 21 to 28%. As I mentioned, they both want to eliminate taxes on tips. So for any service workers, that will really help them out a lot. I know a lot of them have been affected with COVID earlier on, so it's kind of getting that industry in a little bit of a better shape. Raise long-term capital gains for high income earners, right? Those earning above $1 million from 20 to 28%. Also looking to expand startup expenses for small businesses from 5,000 in deductions to 50,000 in deductions. So it'd be a good thing to help people start a new business, right, and grow, which will in turn, right, hopefully lead to hiring other employees and growing the labor market. Now, some more specific ones, taxing unrealized capital gains on the wealthy, right? That means that a wealthy person may have, multiple homes, they might have, multiple investments, and what they've done in the past is they've just hung on to these investments as long as they could, maybe taken loans against them, and just passed them on from generation to generation to avoid a lot of tax. And what essentially this is proposing is, hey, we don't want these families, right, passing this money on from generation to generation and not paying their fair share in taxes. So we want to tax unrealized or investments or properties that have not been sold. We want them to pay some tax on that. One kind of more negative aspect here, and we've already seen this under the current administration, is to look at hiring more IRS agents and performing more audits. And then the final two here is increase the net investment income tax from 3.8 to 5% on income above 400K. And next is to increase the Medicare tax from 3.8% to 5% on income also above 400K. So I'm going to have Neil kind of help out here and explain, a little bit more about
I'm ready.
income tax and the capital gains, just kind of elaborate on how that works.
All right. So capital gains tax rates. So what are they, right? So let's first look at the proposal. The proposal is to charge, go from 20% to 28% for earners above $1 million. All right. So if we look at the capital gains tax rate schedule, we have it right here, and you can easily see how the majority of folks are in the 15% bracket, right? Now, anything over these amounts, right, get taxed at the 20% tax rate. And then there would be an additional tax ring here, which is the 28% for over 1 million, right, for these. So does that affect us? Most likely not, let's be honest, but it could. And here's why, right? Because the way the capital gains are structured is it looks at the entire earnings for the year, which is salary, any income, plus the capital gain. So let's give a scenario, right? I have a $250,000, or let's do even numbers, $300,000 salary. All right. I sell a home that isn't my primary, but I sell a home for $400,000, right? Now, in the eyes of the capital gains tax bracket, I have $700,000 of earned money, okay? Which some of it's going to be taxed as ordinary income, which is my salary. Any income is taxed as ordinary income. The $400,000 of gains is going to be taxed as capital gain. Now, anything under this 584 in the totality of that equation, which was 300,000 plus 400,000, which was 700, anything under that 584 will be taxed at the 15%. So essentially what I'm going to have is $300,000 of my salary is going to be taxed at ordinary income tax rates. So that's probably going to be somewhere in the neighborhood of 24 to maybe even 32% if you're single, right? Then the remaining of this bracket, which would be 284,000, is going to be taxed at the 15% tax rate, which would be that ring there in the middle that I boxed. And then the overage of that, which is 116, is going to be taxed at the 20% tax rate, okay? That's how that works. So that's how the rings would work. Now, if you sold a big property or big stock and all of that combination went over a million, that's where you would experience that 28% tax rate. But in order for that to happen, right, you'd have to sell something for a really good profit, probably a super expensive vacation home or something like that in that scenario.
Mhm.
So most likely doesn't affect a lot of people there, right? Now, you mentioned net investment income, right, David?
Mhm.
Going from 3.8 to what?
To 5%.
Okay. So that would actually apply, in my opinion, to most families. Because if you look at the net investment income tax, it applies to dividends, capital gains, and interest on your investment portfolio. Okay. In addition to that, it's going to be on gains from real estate that you sell or that you sold for profit. Easily, you could come over these thresholds because this also includes your salary. So if I'm at, let's just do the example of $150,000 in salary, right? And I have investment income that includes capital gains. I sold stocks, bonds, whatever, and I had $100,000 of interest, dividends, and capital gains. All of the stuff right here that I just underlined was $100,000. And let's say I file single, right? Let's say I file single. That's a $200,000 cap. That means the combination of my salary and my net investment income will be $250,000. So then what do? I subtract the $200 threshold. And so what that means is 50,000 of my 100,000 income is going to gather an extra 3.8% tax right now.
Mhm.
Now, if this changes, that would be a 5% extra tax on that extra 250. So this tax could actually affect many, call it average American earners out there that have the normal interest and dividends and capital gains and such that they have from investments or real estate. So this one definitely will move the needle on what you pay for tax and will make tax planning that much more important on what you buy and sell and what you shield from taxes in terms of tax deferred investments and so forth.
Mhm. Great explanation. This would, also impact anybody doing Roth conversions and things in retirement, anybody with non-retirement investment accounts, and this would also potentially impact some decisions on property sales. So it's
Yep.
something that you're going to want to really keep in mind with income. And the one thing I'll mention is, as a married filing jointly couple, it's a little bit easier to hit that threshold, whether it's while you're working or in retirement. Especially as federal employees, right? You have a pension, Social Security, required distributions. And we commonly see this in retirement, actually, with a lot of folks who they have all this income in retirement, they have these required distributions, and they don't need that money. So they save and invest that in a non-retirement account, right? That's really the main account that's going to generate these dividends and capital gains and interest. And long term, that's where you can get into a big problem. So the importance of doing these Roth conversions and things early is something that can help you to avoid that in the future.
Yep.
So let's kind of talk a little bit about these two tax plans, right? What are the near and long-term ramifications, right? Also, who is this good for versus maybe not as good for? So the Trump tax proposal would increase our deficits by 5.8 trillion over 10 years. We're going to talk a little bit later about this when we talk about where taxes are really heading. And I know, Neil, you have a great slide on this to kind of show what the issue is with our deficit. Trump's proposal would help the lower, middle, and upper class in the near term, though, as we can very clearly see with those deficits in the long term, we're eventually going to need to pay for that. The proposal from Harris would increase deficits by 1.2 trillion over 10 years. It would be better for lower and middle classes in the near term, and the upper class would be worse off, obviously due to the couple slides we just talked about, right, with the net investment income tax, the capital gains, but also the Medicare tax increase going from 3.8 to 5% as well. Now, one of the big things that we want to just kind of note here, both of these proposals are increasing the deficit, right? We are on a path of essentially heading towards insolvency that will need to be dealt with. So if either of these proposals pass, you want to take advantage of it, but you also want to, really keep in mind, hey, if these are going lower and we already have an issue with our deficit, what's going to happen with taxes in the future? So that's going to be a major part that we talk about. But the next part is we want to just look at where we are right now in taxes, right? We are at the lowest tax rate since the 60s. And we have known about that actually since 2018, right? When the Tax and Jobs Cut Act passed. We knew that tax rates have been low. And, I know, with all of our clients, right, that's been a heavy focus, or anybody on the line who's met with us, that taxes have been a very, very, very big focus of ours because we have these low tax rates and we reasonably expect those to change in the future. And this really just shows, right, that, if we look at kind of where the average tax rate has been, it's a lot closer to that 25 to 26% figure, right, compared to, looking at the average income of a, 100K individual, 200K joint. It's close to, right, 22% right now. So we have these lower taxes, and, if you could, move forward and kind of share where are taxes going?
Yeah, I mean, it doesn't take a rocket scientist to really figure out where tax rates probably are going to go in the future. I think what it comes down to is no administration wants to raise taxes under their watch, right? They want to continue pushing the can down the road, and that's what we've kind of seen. Because at the end of the day, right, most of every single tax dollar right now goes to four things, right? And that's Social Security, Medicare, Medicaid, national debt. Where does all the other expenses we go to? It goes through borrowing, right? The defense of our country, all the programs that we have, all that is coming through borrowing. So at the end of the day, we are the revenue that we have is expected to increase, sure, but so is the outlays. And that's what you're seeing here in this chart. By the year 2033, the deficit will be even greater than what it currently is now by a fairly large margin. So this is the issue that we have as a kind of, let's call it, not an emerging country anymore. We're mature, right? And usually when you start to see these countries or these great powers mature, you start to see issues with debt occur. And we've seen that with Europe, with Greece, these other countries that have struggled mightily with their debt. And when we look at these other countries, right, we can see easily that other developed countries have way higher marginal tax rates than us, right? Looking at most of all of the developed countries that are older than us, we see tax rates 40% or higher. So it's not unusual, or it shouldn't take us for surprise to see eventually those tax rates also start to creep up for the US.
Mm-hmm.
And I'll leave you with one other kind of idea here about the debt. And this is taken directly from the Congressional Budget Office. Absent any reduction in spending, these would be the levels the tax rates would need to rise in order for the US to not go insolvent. And this is super scary because here in 24, the lowest tax rate is 10%. The median tax rate's 24, which again is the lowest we've seen pretty much in history. You know, and David, you mentioned in the 60s, but that was for a brief moment in time, right?
Yep.
So it touched down maybe at those tax rates for a brief moment in time, but this is the lowest, and it's been the lowest for many years now. 37% is our highest tax rung. The computation that they did by 2050 would raise our minimum tax bracket to 19, our median to 47, and our highest to 66. It's not outside of the realm of possibility that that could happen. These tax rates, especially some of the higher ones, have been raised to really high levels in the past. I mean, we have to go back to the 1940s or before that to see rates like that, but it could happen. But bottom line, even if that's not the situation that we face in the future, there has to be at some point a rejiggering of the tax rates higher to account for that debt and that deficit continuing to rise. And we think the time to really start focusing on this is now, you know, and really focusing on that sweet spot in terms of the tax code. So we've put this together for you guys so you can understand why we're constructive on paying off your taxes now, why David alluded to doing Roth conversions now, why we've been telling our clients this. But if we really look at this, what we call the sweet spot, why do we call this the sweet spot? Well, we call it the sweet spot because the difference between 22 and 20%, 24%, is not much. That's been the lowest amount of change between those two brackets ever. Usually it was from 25 to 28. It was a bigger jump in terms of what you're paying. The other thing too is the amount of income that this bracket commands is super wide, right? So you can actually take advantage of that wide bracket as a single or even joint and start to utilize pushing some money out to Roth before tax rates in the future start to get larger. And the biggest concern that we're seeing across all of our clients, which are mainly federal, is we haven't seen TSPs this large ever. We've had a really good market. We've had huge surge from the US stock markets over the last couple of years, where we've seen really elevated retirement plans that are mostly all traditional based. And so that means come your mid 70s, right? Early to mid 70s, you're going to be sending out a huge sum of money that is required to take out. And that's likely going to come on the backs of some of those higher tax rates, 32%, or by then these tax rates could be adjusting in the wrong way for you. So that's where we're kind of giving you that green light. Hey, please start to look at this stuff now. Don't wait till later. David, is this a slide that you wanted to cover, or did you want me to cover this one?
I think it goes hand in hand with your thought process here, but I can elaborate on it after you.
Sure. Yeah. I mean, just to kind of sum this up is here's the tax rates over on the right side prior to the changes that took place in 2018. It's very easy to see the differences. And I think the stark difference is highlighted right there for everyone to see, which is that $233,000, the 28% tax bracket, right, went to 233,000 for joint. So for joint, people were actually pinched there. Like the single bracket went from 92 to 191, and I lost my drawer here, or else I'd be drawing on this. But the single, oh, there it is. The single bracket was a lot wider, right? but the joint bracket was actually kind of got the bad end of the stick there, right? So that was a super shallow bracket of only about 70K. The difference is now is that joint bracket is 180K and the rate is lower, right? The rate's lower. So, it's a no-brainer in most cases to take advantage of that 24% bracket. That's why we call that the sweet spot. So, David, what do we got in terms of folks taking advantage of this if they're not current clients?
Yeah, actually jump back one slide real quick.
Sure.
There's just one other part that I want to kind of add to this about, doing these tax planning techniques now. We mentioned 24 is the sweet spot. And one of the main reasons it's the sweet spot, right? That is the fourth tier, if you will, of tax rates here, 10, 12, 22, and then 24. And if you look at the third tier from back in 2017, right, that was 25%. So even if your income was to hypothetically drop, I just want to point out that paying 24 now would still be cheaper than 25 in the future.
Good
And
point.
that's one of the other reasons why we mentioned this is really the sweet spot.
Good point. Good point.
All right. So, if you're not a client, if you're a client, first off, you know how to reach us. We're always happy to meet. If you're not, we do offer a financial checkup. It covers essentially all of these questions listed here. And I think really the main part from today's presentation is just, hey, should I be using Roth? Should I be using it in my TSP? Should I be doing conversions? What other things can I do tax-wise to really help myself avoid this future, very likely increase in taxes? What things can you be doing now to protect yourself from that? Now, this is also a session to ask questions about anything and everything about your financial picture. So we do have a QR code as well as below that the website where you can register for that. And that will be, a complimentary session. If you have a spouse, obviously we encourage them to join as well. And other than that, I think what we'll do is we'll kind of, start looking over towards questions. If you're not already subscribed to our YouTube channel, there's a lot of other great content, not just our commentaries. I know, Neil, you put out a really good series on Medicare lately. I've actually had a number of people watch that and it answered a lot of their questions. So if you haven't checked that out, make sure you do. Here's the QR code again to subscribe for the YouTube, but most of you are probably watching this live right now. So feel free to subscribe and check out the new content.
And like the video. Liking this video actually promotes it into the algorithm space of YouTube. And we got a lot of catching up to do. We just started this channel this year. So anything that you can do, whether it's liking the video, subscribing to the channel, sending the videos out to your colleagues and friends, that all helps this channel get more exposure. So I think that's about it for today, right? Do you have anything else to add, David?
Yeah, no, that would be it. So we'll just kind of jump over and look at any questions. If we don't get anything coming in, then it looks like we actually have a few.
Okay.
Let's see here. So we got about 4. So I will just kind of read them out. The first question is the upcoming presidential election likely to affect what the Federal Reserve does? Neil, would you like to take this or would you like me to add in?
You could add in.
Okay. So the election, of course, will play an impact based on also, as you saw, the different tax proposals here, because we're looking at, right, deficit increasing, maybe one more than the other. And they're going to have to make sure that we balance the interest rates that we're charging, because one thing we have to keep in mind, whatever the Federal Reserve is charging as the interest rate also becomes a benchmark for what we need to pay on our national debt, right? So they don't want interest to be really high when we have all this debt. They want eventually that rate to come down as well. Now, does the election typically have a big impact on it? No. And even on the stock market, the typical election has more of a minor impact. It's more of a temporary swing one way or another. But the election normally doesn't have this big impact on either of those. Anything you want to add to that, Neil?
No, I think that solves it. So we could look at Mike, right? He mentioned the standard deduction for married folks is $29,200. So this was in. Thanks for pointing that out, Mike. I didn't have that figure in front of me, but essentially what Mike's saying is, right, that SALT tax with the $10,000 limit being removed likely won't impact the married folks as much because you've got this $29,200 standard deduction, which you can take in exchange for itemizing. So the SALT tax pretty much removes any shot of a joint filer itemizing. But if it were to be thrown out and now you get to itemize your full amount of property, state income taxes as well, maybe you get to $29,200, maybe, right, with maybe some other deductions like charitable deductions and so forth, but still might be difficult to do. And if you did, it's probably not much more than that. But what I do think it's going to help is that single filer.
Mm-hmm. Yep.
Next question, Mike says, is it does mean you'll need to come up with $50 to $75K unless you take it down from what you're converting to Roth. Not sure what that means. Do you know what he's referring to, David?
That was typed quite a bit later, so I think that was in context to a different different topic. But I do think plus additional state. Yeah, I'm not sure which slide that is specifically referring to. Mike, if you're still here, if you could elaborate, we'd be happy to answer.
That's okay. We know who Mike is. We could take that offline or on email. I don't want to tie up everyone else, but he just mentioned for Roth conversions. Essentially, what he's saying is, if you convert to Roth, you'll need to come up with money to pay the taxes off to convert to Roth, unless you take it from the Roth conversion. So yeah, fair point, Mike. You got the option of coming up with it on your own or removing it from the conversion. It just depends on what your cash flow scenario is outside of your retirement plans or how much you've saved outside of those retirement plans. Point taken.
Yeah.
All right. Well, I think that concludes all the questions. Thanks for everyone for tuning in. And as always, we'll have another one of these in a month. And stay tuned for that, as well as to David's point, some of the other videos that we're getting out on our YouTube channel that are more short and topic specific. That's really been my goal, to get more of those out to you. And we'll have a few more coming out in the weeks ahead.
Yep. And if anybody has any kind of content or anything that they'd love to see, please let us know. We'd love to include some things. As you saw, we don't want to just cover the market and the economy. We want to cover, events, things with federal benefits, things with, as you saw, with the tax code. So if there's anything that is on your mind and you'd love to see, let us know. We're also going to try and incorporate a little bit more topic-specific things into these presentations, so that you're getting a little bit more information than just on the markets.
All right, I'm shutting it down. We'll see you guys on your one-on-one meetings and things like that. Thanks for tuning in, and have a wonderful rest of your October.